This video is about equity valuation. What is common stock? Common stock is defined as an instrument that represents the ownership in the company that issues the stock. A stockholder is part of the owner of the company that issues the stock and has a claim on the earnings and asset of the corporation. If you invest in stock, your return could be in the form of dividend declared by the management of the company or capital gain if there is an increase in the demand for the share price. What are the advantages of stock ownership? First, you can get high return. Stock provide opportunity for higher returns than other investment. For example, if you analyze the data over the past 50 years, stock average 11% and high-grade corporate bonds average at 6%. So it shows that you can get high return if you invest in stock compared to other investment instruments. Then you can also get a high liquidity. High liquidity means easy for you to trade the stock. You can easily buy or sell the stock by going to Bursa Malaysia. Compared to other financial instruments, for example, you invest in real estate. Some asset in real estate, you need to take at least 1 year to complete the sale. So in terms of liquidity, shares are one of the most assets that are liquid in the market. Next, it's easy for you to get the information about the price and the market itself, because listed company is reported in financial media and internet. The next advantage, unit cost per share of stock is low enough to encourage ownership. You can buy shares worth 50 cents. If you have more money, you can buy shares worth 100 ringgit. Next, we have variety of choices in stock exchange. We have halal stock, we have non-halal stock, we have cyclical stock, defensive stock. So there is a lot of choice stock in stock exchange. What are the disadvantages of stock ownership? Some of the disadvantages. First, stocks are subject to many different kind of risks because stock offer high return, so it's carry a lot of risks. For example, stock affected by business risk, financial risk, market risk, and event risk. The next disadvantage of investing in stock is it is very hard to predict which stock will go up in value due to the wide swings in profit and general stock market performance. So it's very difficult to make a market prediction for stock price. You need to have a lot of experience, a lot of skill, and a lot of knowledge. Next, to calculate the intrinsic value may be one of the biggest obstacles, difficult to predict future earnings. In finance, when we want to calculate the intrinsic value or the fair value of the asset, basically we need to identify what is the future cash flow of the asset, and then we discounting the future value to get the present value of the asset. Compared to bond you can have a stable coupon payment. You can get similar coupon payment every year. That's why it's easy to calculate the price of bond. We have only one formula to calculate the price of bond, which is the present value of coupon payment and the present value of the principal. But for shares, there is a lot of variability of dividend for shares. So it's very hard to predict future cash flow from the share. That's why it's very difficult to calculate the intrinsic value or the fair value of shares. So if you look at this lecture, at the end of this lecture, I will cover the valuation of stock. There are a lot of methods to calculate the price of share. Now we move to the difference between debt and equity. So what is debt? Debt includes all borrowing incurred by a firm, including bonds, and is repaid according to the fixed schedule of payment. Whereas equity consists of funds provided by the firm's owner, which is the investor, or we call it as a stockholder, that are repaid subject to the firm's performance. So debt financing is obtained from creditors and equity financing is obtained from the investors, who then become part owners of the firms. Creditors have a legal right to be repaid, whereas investors, as the owner of the company, have an expectation of being repaid. Unlike credit, in terms of claim on income and asset, the difference is equity holders' claim on income and asset are secondary to the claims of creditors. Their claims on income cannot be paid until the claims of all creditors, including both interest and scheduled principal payment, has been satisfied. Because equity holders are the last to receive distributions, they expect greater returns to compensate them for the additional risk they bear. So if the company make income, first the company must pay their interest first. So interest is for bondholders or debtors of the company. If there is any income after they pay the interest, then the company can pay the dividend to the shareholders. Difference between debt and equity. So we look in terms of claim on income and asset, how assets are divided in bankruptcy. According to the regulation of financial market, in bankruptcy, assets are divided as follows. First, company must pay secured creditors first. So secured bank loans or secured bond are paid first. Then the company needs to pay unsecured creditors, unsecured bank loans or unsecured bonds. Suppliers or customer have the next claim. If there is any balance, then the company can pay the equity holders. So equity holders or the owner of the company have the last claim on the asset, and they may not receive anything if the secured and unsecured creditors' claims are not fully repaid. How about your maturity? Unlike debt, equity capital is a permanent form of financing. So equity has no maturity date and never has to be repaid by the firm. So the difference between debt and equity in terms of tax treatment, interest payments to debt holders are treated as tax-deductible expenses by the issuing firm, whereas dividend payments to a firm's stockholders are not tax-deductible. The tax deductibility of interest lowers the corporation costs of debt financing, further causing it to be lower than the cost of equity financing. Common stock dividends. The payment of dividends to the firm shareholder is at the discretion of the company's board of directors. Dividends may be paid in cash, stock, or merchandise. Common stockholders are not promised a dividend, but they come to expect certain payments on the basis of the historical dividend patterns of the firm. Before dividends are paid to common stockholder, any past due dividends owed to preferred stockholder must be paid. Now we look at preferred stock. What is preferred stock? Preferred stock gives its holders certain privilege that make them senior to common stockholders. Preferred stockholders are promised a fixed periodic dividend, which is stated either as a percentage or as a dollar amount. Par value preferred stock is preferred stock with a stated face value that is used with the specified dividend percentage to determine the annual dollar dividend. No par value preferred stock is preferred stock with no stated face value but with a stated annual dollar dividend. What are the basic rights of preferred stockholder? First, preferred stock is often considered quasi-debt because it, much like interest on debt, it specifies a fixed periodic payment. Preferred stock is unlike debt in that it has no maturity date. because they have a fixed claim on the firm's income that take precedence over the claim of common stockholders, preferred stockholders are exposed to less risk. Preferred stockholders are not normally given a voting right, although preferred stockholders are sometimes allowed to elect one member of the board of directors. Some other features of preferred stock. First, preferred stock has restrictive covenants, including provision about passing dividends, the sale of senior securities, merger, sales of asset, minimum liquidity requirements, and repurchase of common stock. Cumulative preferred stock is preferred stock for which all past or unpaid dividends in arrears, along with the current dividends, must be paid before dividend can be paid to the common stockholders. Non-cumulative preferred stock is preferred stock for which past or unpaid dividend do not accumulate. A callable feature is feature of callable preferred stock that allows the issuer to retire the shares within a certain period time at a certain specified price. A conversion feature is a feature of convertible preferred stock that allows holder to change each share into a stated number of shares of common stock. Now we move to the valuation of stock. So we have 5 methods to calculate the price of stock or the fair value of stock. The first model is fixed dividend model. The second model is constant growth model or Gordon growth model. The third model is variable dividend discount model. The fourth model is supernormal growth model. And the last model is earnings multiplier model. How to make investment decision in stock market. First, you need to calculate the fair value of the stock or the fair value of the share. Then you need to compare with the market price. You do not invest in stock when the fair value of stock is less than the market price of stock, or we said the stock is in overpriced condition. We only invest in stock when the fair value of stock is more than the market price of stock, or we call it as an underpriced condition. The first model is fixed dividend model. When to use this model? We use fixed dividend model when the company pay fixed dividend every year. So this model is used to calculate the value of preferred shares. So when we say fixed dividend, that means there is no growth rate of dividend. For example, company pay RM5 ringgit dividend every year, and this dividend is fixed for every year. So the formula for this dividend model is P0. P0 here means price of share at year 0, or the fair value of share at year 0, equal to dividend in RM, which is D, divided by K. K is our required rate of return. So how to calculate dividend? Dividend is equal to dividend rate times par value, or sometimes if you don't have the par value of the preferred shares dividend, the dividend rates will multiply with the market price of share. This is example for fixed dividend model. Calculate the preferred share of ABC company if the company offer 5% fixed dividend, RM100 par value. Would you buy the preferred share if your required rate of return is 8% and the share is currently priced at 55 ringgit and 80 cents? So first step, you need to calculate the dividend in ringgit. So dividend rate is 5% times par value is 100. So you get 5 ringgit. So you plug in all the figures into the fixed dividend model. So price of share equal to dividend divided by K, required rate of return. So RM5, the dividend, divided by 8%. So you get 62.50. So 62.50 is the fair value of the share. To make investment decision, you need to compare with market price of share. So currently, the share is priced at 55.70. The actual price of the share is 62.50. So you should invest in stock when fair value of stock is more than the market price of stock, or we call it underpriced stock. The second model is constant growth model, or we said the other name is Gordon growth model. So when to use this model? We use this model when the company has a constant growth rate. For example, the company paid last year dividend 5 ringgit and the growth rate of the company is constant at 7% per year. So to use the constant growth model, you must have constant growth rate, not constant dividend, constant growth rate. So this is the formula for constant growth model. The formula is P0 equal to D1 minus divided by K minus G. So P0 is a price of share in year 0 or fair value of share in year 0. D1 is next year dividend in RM. K is required rate of return. G is the constant growth rate of the company. So formula for D1, you must make sure D1 is the next year dividend. If you have this year dividend, for example, the company pay 5 ringgit this year, so that is considered as a last year dividend payment. So this year dividend or last year dividend is considered as D0. So how to calculate D1? So the formula for D1 or next year dividend is equal to D0. D0 is this year dividend or last year dividend times or multiply by 1 plus growth rate to the power of 1. Okay, so for this formula, if you want to play around with this formula, example to calculate D5, let's say the question asks you to calculate what is the dividend payment for year 5. So you can use D5 equal to D0, 1 plus G to the power of 5, or you can use formula D5 equal to D1 times 1 plus G to the power of 4, or you can use formula D5 equal to D3 times 1 plus G to the power of 2. This is example for constant growth model. ABC company paid 3 ringgit 50 dividend last year. The growth rate of the company is fixed at 6% per year. Currently, the ABC share is selling at price 130. Would you buy the share if your required rate of return is 9%? So first, you need to calculate D1. So D1 equal to D0 plus times 1 plus G to the power of 1. So D0 given in the question is 350 times 1 plus 6%, the growth rate of the company to the power of 1. So you get D1 equal to 3 ringgit 71 cents. So you plug in the figures into Gordon growth model formula. So D1 3 ringgit 71 cents divided by required rate of return 9% minus growth rate of the company 6%. So you get 123 ringgit and 67 cents. So to make investment decision, you compare with market price of share. So currently the price is selling at 130. So do not invest in stock and the fair value of stock is less than the market price of stock, or we said it is in overpriced condition. This is example if you want to use constant growth model to calculate future price of share. For example, ABC company paid RM 303 ringgit and 50 cents dividend last year. The growth rate of the company is fixed at 6% per year. The expected market price of share in year 3 is at 145. Would you buy the share if in year 3 if your required rate of return is 9%? So in this question, you need to calculate price in year 3. So to calculate price in year 3, you need to have dividend year 4. So to calculate dividend year 4, D0, 1 plus G to the power of 4. So 350 times 1 plus G growth rate 6% to the power of 4. So you get D4 equal to 4 ringgit and 42 cents. So you plug into the golden growth model formula. P3, price in year 3, equal to D4 divided by K minus G. So 4 ringgit and 42 cents divided by 9% minus 6%. So you get 147 ringgit and 33 cents. Then you need to compare with market price in year 3. So basically the fair value is 147. The market price is 145. So you invest in stock when fair value of stock is more than the market price of stock, or we say it is under price condition. The next model is variable dividend discount model. So when to use this model? The dividend paid is changing every year with no constant growth rate of the company. Okay, so to use this model, you need to have a company where the dividend is keep on changing every year without any constant growth rate of the company. You can have expected market price of share at the end of your investment holding period. The second condition, you must have the share price at the end of your investment holding period. And then value of share today is basically the sum of present value of all future dividend and present value of price of share at the end of your investment holding period. So this is example for variable dividend discount model. You are considering to invest in ABC shares for the next 3 years. The ABC company expected to pay RM2.50 dividend in year 1, RM3.60 dividend in year 2, and RM5.7 in year 3. The expected market price of shares is 35 ringgit at the end of year 3. Would you buy the share if your required rate of return is 8% and currently the share is selling at 35 ringgit? Okay, so to answer this question, if you look at the information given in the question, we have variable dividend payment from year 1, year 2, and year 3. So the dividend is keep on changing from year 1, year 2, and year 3. And then the second one, we have the price of share at the end of year 3. So we can use dividend discount model. So basically, variable dividend discount model, we sum up the total present value for the dividend and the total present value for the market price at the end of our holding period. So if you look at this timeline, you have year 1, year 2, and year 3. Year 1, you receive dividend 250. Year 2, dividend 360. Year 3, you receive dividend 570. And then you sell that share at price 35 ringgit. So we calculate the total present value of all this future cash flow. So you get the total present value is 37 ringgit and 70 cents. So this is the fair value of the share in year 0. Then you need to compare with market price of share. So currently the share is selling at 35 ringgit. The value is actually at 37 ringgit. So you should invest in stock because the fair value of stock is more than the market price of stock. So it is an under price condition. Next, we move to the supernormal growth model. So when to use this model? So this model is used when the dividend has constant growth rate after a certain period of time. So the constant growth rate is not occur during all the time. After certain period, the growth rate become constant. For example, the growth rate of company ABC is expected to be 5% in year 1, 7% in year 2, and year 3, and start to resume the normal growth rate of the company constantly at 5% in year 4. So if you look at this example, the growth rate only become constant from year 4 and above. So before year 4, the growth rate keep on changing. That's why we call it as a supernormal growth model. So we have a constant growth rate after a certain period. We look at this example. Consider a stock with dividends. So first step, you need to calculate dividend for every year until 1 year after the growth rate become constant. Okay, so growth rate become constant in year 4. So we need to calculate dividend until year 5. If the growth rate become constant in year 2, we need to calculate dividend until year 3. So we calculate dividend for every year until 1 year after the growth rate become constant. So in this case, growth rate become constant in year 4. So we calculate growth rate, we calculate the dividend payment until year 5. Okay, so how to calculate dividend for every year? For example, you want to calculate D1. D1, the formula is D0 times 1 plus G to the power of 1. If you want to calculate D4, so D4 is equal to D3 times 1 plus G to the power of 1. Okay, so first step, you calculate dividend for every year until 1 year after growth rate become constant. So you get D1 3.60 ringgit, D2 4.14 ringgit, D3 4.76 ringgit, D4 5 ringgit, D5 5.25 ringgit. Step number 2, you need to calculate price of share in year growth rate become constant. Okay, so if you look at this timeline, the growth rate become constant in year 4. So we need to calculate price of share in year 4. So to calculate the price of share in year 4, we need to use D5. So D5 divided by K minus G. We already calculated D5 from the previous step, which is 5.25 ringgit. Divide the growth rate 5%. The required rate of return is 9%. So you get 131 ringgit and 25 cents. So this is step number 2. Step number 3, you need to calculate total present value of dividend until growth rate start constant and present value of share price at year growth rate become constant. So in this example, the growth rate become constant in year 4. So we need to calculate present value of all dividend from year 1 until year 4, and then we need to calculate the present value of market price of share in year 4. So we calculate the present value and we sum up, you get fair price 106.98 ringgit. Then you can make investment decision. So the market price of share in year 0 is 100. The fair value of share in year 0 is 106.98. So you invest in this stock because the fair value of stock is more than non-market price of stock. Next, we move to the earnings multiplier model, or sometimes we call it as a PE ratio model. So when to use this model? This model is used when you have information on the PE ratio of the company. So earning multiplier models, the formula is price of share P0 is equal to EPS times PE ratio. So EPS is the earning per share, PE ratio is the price earning ratio. This is example earning multiplier models. The reported price earning ratio and earning per share for ABC company is 10 times and RM 100.50 respectively. Would you invest in ABC share if the current market price of share is at RM 17.50? So price of share is equal to EPS times PE ratio. So the earning per share for this company is 150 and times 10, the PE ratio is 10, that's mean the price is 15 ringgit. So if you compare, the market price of share is 17.50, the fair value is only at 15 ringgit. So you do not invest in stock when fair value of stock is less than the market price of stock, which is the overpriced condition. So that's all for stock valuation. Thank you.